You do not need to have a lot of money saved just to buy a home. The biggest mistake that first-time home buyers make is they think they have to have 20% saved to buy a home. In this video, I'm going to show you 5 programs that you can buy a home with 3% down, maybe even 0 down payment. I'm going to break these down very simply so you can get a good idea of what might be the perfect program for you. All right, let's get into it. Before I jump into this handful of great options with 0 down and low down payment, I want to talk about a bigger concept and a fallacy that's out there. The piece is I have to have 20% to put down. If I don't have 20% down, I can't buy a home. I'm going to show you some great options that's not the case. And I want to share something else with you on a really big perspective. Let's take a $300,000 home. And let's say it is going to take you another 2 years to save a 20% down payment for a $300,000 home. 2 more years. Let's talk about what I think is going to happen in many markets across the country in the next 2 years. I would not at all be surprised to see home prices go up 10% per year in each of the next 2 years. So while you're trying to save your 20% down payment, that $300,000 house is now $360,000. Maybe I'm wrong. Maybe it only goes up 5%, but I do think 5% is ultra conservative, and that $300,000 house is now $330,000. So when you look at some of these programs, keep an open mind towards getting in, owning something, making your payments, and letting that equity run to your advantage instead of just being in that mindset, well, I have to save because my uncle or my mom or my dad, or I read something online. Keep an open mind as you walk through these today. The first program you need to be aware of is what is one of my all-time favorite programs and the exact loan that I used when I bought my first house. And you know what? It only cost me 3.5% down payment. It's an FHA loan. FHA loan is fantastic for first-time home buyers, but it's not excluded to just first-time home buyers. It can be anyone. The big advantage to FHA, it's a low down payment, 3.5% down payment. FHA allows for lots of great things. One of them is you don't have to have perfect credit. You don't have to have 800 credit, 7 some credit. The loan goes all the way down to 580. In some cases, you can even do the loan without a credit score. But also, the program allows the seller to pay a significant portion of your closing costs and costs associated with buying the house. FHA allows up to 6% of the sales price. Depending on where you live, you may not need the whole 6%. Some places you may need the whole 6%. In my home state of Michigan, 6% on a $200,000 or $300,000 loan is way too much with the way we handle property taxes, and our costs are always low, but it varies case by case around the country. Love FHA loans, something to look really hard at. Make sure you're working with someone that really understands that program. So one of the things you may look at is, well, is the FHA loan right for me? There's other loan programs where I see the sweet spot on FHA is maybe a borrower that doesn't have that exemplary credit score, that 740, 760, up in that high 700 credit scores. A lot of our borrowers qualify for this in that lower credit tier. And one of the reasons why is when your credit score is lower in most loans and conventional mortgages, as your credit score goes down, your mortgage insurance becomes more expensive. Also, your interest rate gets higher with the conventional loan. FHA is more forgiving. The mortgage insurance is the same if you qualify for the program with a 740 credit score or a 620 credit score. That range ends up being the same, so you're not paying a premium for having a credit score a little bit lower. The other big thing is if your credit's good, and especially your recent credit, meaning maybe your score is a little bit lower, but you've had great recent credit history. Talking 12 months, 18 months, 24 months, that great trend in that recent credit histories allow you to get into a very low interest rate with competitive mortgage insurance. My sweet spot in this with most clients is in that lower tier, in that 580, probably up to about 680, maybe even 700. The other thing that FHA does, it allows your debt to income to be higher in some cases than conventional mortgage. Now, I never want to get someone into a really high debt to income situation when they're buying a house that they can just barely afford and barely squeak into. Where I get a little more comfortable with that is when maybe someone has additional income. Let's say we have a husband and wife and one won't qualify for the mortgage because maybe they have a new job. Maybe it's commission-based job. Maybe they've got a side hustle that they're earning cash or something else. The kind of income that I can't use for mortgage qualification, but I know their household income is going to be able to support it because while the mortgage can't use that money technically, it's still coming in every month. So if you're in a spot that maybe you have this other income coming in from a spouse or a side hustle or another job or commission that has some really good high side, feel a little bit better getting in that higher debt to income, how much money is going in, how much money is going out every month. And FHA generally allows those numbers to go higher than a typical conventional mortgage product. So if you're someone with a little lower credit score and you're concerned you couldn't qualify because you didn't have a giant down payment and you didn't have great credit, it's a great program to take a look at. And one last thing, when we talk about down payment, FHA allows a gift for that 3.5% down payment from a family member or a family type relationship. So keep that in mind as well. The second program to consider, and it's not for everyone, not because I wouldn't love to get it everyone, but you have to be a veteran to qualify for this. It is a VA mortgage and it is chock full of awesome benefits that veterans earn from serving our country. Starting with, the VA loan allows you to buy with zero money for a down payment and zero on a monthly mortgage insurance. It is really an awesome program. Like the FHA loan, we can negotiate to have seller pay closing costs and prepaids, and in some cases, negotiated correctly with a real estate professional putting a deal together, that veteran could truly come in with zero down payment and zero out of pocket for closing costs and prepaids if those were negotiated. The VA loan, as we said earlier, does not have monthly mortgage insurance, but there is an upfront funding fee. Now that fee's not out of pocket, but it is added to the loan. Every single veteran pays that funding fee. It changes whether you're a first-time user or a multi-time user for the VA program. Also, the VA funding fee can be waived if the veteran has a disability status. And if that's the case, they could get in with zero funding fee. So truly zero down, zero funding fee. So again, when we talk zero down, that's zero down for the loan. Now there are closing costs and prepaids, and the seller can pay those closing costs and prepaids if you negotiate to have those costs paid when you're writing the purchase contract. If that's the case, you can truly get in with zero down. If the seller paid your closing costs and prepaids, it truly be zero. Great program. The last thing I'd say with VA is this. Sometimes real estate agents don't want to take VA loans. And the reason why, in my professional opinion, there's a couple giant VA lenders out there that I think their service level, in my opinion, is subpar. In our market, I always call the listing agents when I get a buyer that's using their VA loan. And I explain to the agent representing the seller that this is part of their veterans benefit. They served our country, and this is one of the things they got in exchange for serving our country. And honestly, I put a pretty hard sell on this that we should look at this and not exclude it just because of VA loan. VA does have a couple rules regarding home inspections and some different things, but at the end of the day, very minimal items, and VA shouldn't be excluded because of a couple lenders out there that don't do a great job. You find a good local lender that is an expert in VA loan, there's no reason why you can't get your offer accepted using a VA mortgage. The next program is very similar to a VA mortgage, but you don't have to be a veteran to qualify. It's a USDA Rural Development Loan, an RD loan. Great thing with RD loan, it is zero down. You do not need to have anything to put down. Like FHA, the seller can contribute up to 6% in closing costs and prepaids if you negotiate that. So again, it can truly be zero down and zero out of pocket if you negotiate to get the seller to pay closing costs and prepays. The thing with rural development is there are certain areas that qualify and there's other areas that don't qualify. There are maps, and you can find maps in your area of what properties qualify for the USDA rural development. Now, you might be thinking, well, I don't want to live out in the country on 50 acres and a long ways away from everything. Rural development isn't as rural as you may think. In my home market, if we get outside of town, maybe by 5 miles or so, we open up where the whole radius around is rural, where you're right outside of major metropolitan areas, but you still technically meet that rural category. Something to consider with rural development is if you look back 20 and 30 years ago in these areas that have sprawled out and become bigger and bigger, they've grown outside of metropolitan areas. With remote work being what it is and many people being able to work throughout the country, to potentially get somewhere that's on the edge of a booming metropolitan area where you still fall into that rural development piece and you can take advantage of possibly lower house prices using a mortgage with zero down payment and secure something that probably is going to appreciate in value if that urban area continues to grow out and house prices typically go up as you get closer to major metropolitan areas. I think this is a great opportunity to look at working remote, capturing a rural loan, and going zero down. Number 4 to talk about, while it's not low down payment, it can be used for a low down payment program. It's basically securing funds from state bond loans. And a state bond loan where a state or a local municipality will give money to a buyer to use for a different loan program. It could be used in conjunction with FHA or rural development or even a conventional mortgage. Now, the thing with bond loans is a lot of people think it's free money. And it's different state by state, and it's managed differently across the country. You can find what your state is by looking up state bond loans and what's available for home buyers and first-time home buyers. In most cases, speaking in broad terms, it is not free money. It is some sort of a grant or a loan that will be paid back at some point. But if you're in a spot that you can't get into the house and you don't have access and you don't have that down payment, this could be something that could help you bridge that gap to get into that first house. And while you may have to pay it back, depending on the state and municipality and locality that you're in, it's okay because you get in, you're able to build equity, and that equity is yours in the future, even if you do have to pay that loan back. Interest rates are competitive. Some states, they're subsidized where they're even lower than the going rate. It's a case by case, state by state. The broad reference and the broad term are state bond loans. Look up your state, look up bond loan, and see what programs come up when you do an internet search. Last, but certainly not least, is a conventional mortgage loan program. Typically is used for borrowers with stronger credit, oftentimes first-time home buyers, where they can get in with as little as 3% down. That 3% down is one of the many attributes and one of the many strong selling features of this program. The other big piece is that oftentimes for first-time home buyers in this program, the interest rate is lower than a conventional mortgage. So let's say we've got a borrower with a 740 credit score. They're buying their third or fourth house. They have 20 or 25% down payment, AAA everything. In some cases, that borrower buying with just 3% down can get a better interest rate than that borrower with 25% down in great credit. The GSEs, government-sponsored enterprises, our tax dollars basically came in and saved Fannie Mae and Freddie Mac years ago. One of their directives are to find options for first-time homebuyers with low down payment and discounted mortgage insurance rate. Mortgage insurance is what you pay as a borrower when you put less than 20% down. There's more risk to the lender when you have less money into the deal. Some of these programs, the mortgage insurance has been dramatically reduced. I'll give you a great example. When I bought my first house years ago on an $80,000 home, putting down 3.5%, my mortgage insurance was $150. This was on an $80,000 home. Just helped the client last week using one of these conventional programs, putting down just 3% on a $300,000 loan, and their mortgage insurance was about $65 a month. So compare mine at $150 or whatever that was, $180 compared to $65 on a $300,000 house. Great loan programs that are set up to help people get in with low down payment, low mortgage insurance, low interest rates, and help people make that big jump to become a first-time home buyer with very little down. So we've covered a handful of low down and no down programs to buy a home. I will tell you, with over 20 years experience in the mortgage business, without a doubt, my favorite group to work with are first-time home buyers. It can be overwhelming. How does this work? How does the process work? What options are available to me? Find somebody that has that passion for helping people get in with low down payment. Find someone that's willing to do the work and explain it to you in detail. I often talk about my experience in buying, where the loan officer was across the table in the big chair, and I think she cut the legs off in the chair, so my chair was lower, and she was talking down to me like, sign here, and here's option this, and this is what you have to do. I wasn't empowered, and I didn't understand the program. I think it's essential to find someone that you feel really comfortable with, that's going to sit there and explain all options to you, so you are empowered and you understand everything as a first-time buyer. There are loan officers out there that love doing $1 million, $2 million, $10 million deals. And don't get me wrong, I love to do those big deals too, but what I'm really passionate about is helping first-time home buyers. So find someone that meets your personality. Find someone that you're really comfortable with. I will tell you this, there is very little difference between lender A and lender B with a reputable lender. So reputable lender A and reputable lender B. There's a bunch of unreputable people out there. There's very little difference between reputable lenders. Find who you're comfortable with. Find who's going to help you understand the process and accomplish your goals. So in the description, if you'd like to talk to me, I'd be honored to talk to you. My number's below, my contact information's below. Maybe I'm the right guy for you.